It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, Chinese regulation. After a falling out between Alibaba head Jack Ma and the CCP over criticism of China's financial system late last year, Chinese regulators have been quiet for some time. The move saw stringent regulations introduced on Ant Financial, and the company has since lost $70 billion in value. However, recent developments have seen other Chinese tech giants fall into the CCP's eye. Among them are Tencent, JD.com, TikTok owner ByteDance, and new IPO Didi Chuxing, the Uber of China. Notably, just following its IPO, Didi had a number of its apps shut down due to violations. This is effectively like having the Uber app removed from the App Store. Additionally, Tencent has seen the large merger of 2 video game streaming sites blocked. The index tracking US-listed Chinese tech stocks has fallen over 10% in the past couple of weeks. This trend in increased regulation around tech bears watching, as it has implications not only in China but potentially on the political environment in the US as well. Number 2, inflation expectations. The recent rise in inflation in the US has been well documented, and Fed commentary seems to continue to suggest a belief that the current rate of inflation is transitory. However, by one of the Fed's own measures of consumer inflation expectations, consumers aren't buying it. The New York Fed survey of 1-year inflation expectations rose the most on record to reach 4.8%, an all-time high in the series. This compares to a Fed forecast of 3.6% over the 3-year horizon. The survey saw rises in housing, medical expenses, and education, which are typically stickier, and saw modest decreases in expectations surrounding food and energy. While a consumer survey may not be the most reliable way to predict future inflation, the magnitude of these moves is notable and may have implications for consumer sentiment and buying preferences in the future. Number 3, Treasury Yields. Typically, the yield on longer-term U.S. Treasury bonds is a fairly solid measure of the market's future growth and inflation expectations. As the economy reopened and growth picked up, we saw the U.S. 10-year Treasury yield rise from 0.6% to 1.8%, which was a level similar to where it was pre-pandemic. However, perhaps driven by dovish Fed commentary, the 10-year yield has fallen back below 1.4%. This is an interesting development, as it appears the bond market is effectively saying that growth and/or inflation will disappoint in the coming years. These longer-term interest rates are ultimately the discount rate on the stock market, so we will be watching closely. And that's been your Market Minute for the month of July. Thanks for listening.